Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 134, and in this episode we are reviewing the performance of the global markets during the 46th week of 2024, and that is from Monday the 11th to Friday the 15th of November. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where inflation picked up slightly in the month of October, and that was pretty much in line with Wall Street's expectations. On Wednesday, the Bureau of Labor Statistics released the latest Consumer Price Index, which measures the changes in prices for a basket of common goods and services. And this data showed that inflation increased by 0.2% for the month and by 2.6% over the past 12 months. This was an increase of 0.2 percentage points from the 2.4% that was recorded in the month of September. Excluding food and energy prices, the core consumer price index accelerated at a much faster pace of 0.3% for the month and by 3.3% on an annual basis. Following the release of the data, traders raised the odds that the Federal Reserve would indeed cut its benchmark interest rate by another 25 basis points at its December policy meeting. And over to the United Kingdom, where the economy showed a surprise contraction in the month of September and only managed to record marginal growth in the third quarter, following a strong rebound at the beginning of this year. According to the Office for National Statistics, the gross domestic product fell by 0.1% in September and grew by just 0.1% for the third quarter of 2024. This was below the expected growth rate of 0.2% and significantly lower than the expansion of 0.5% that was recorded in the second quarter of this year. This data comes after inflation in the United Kingdom fell sharply to 1.7% in September, dipping below the Bank of England's target rate of 2% and paving the way for the central bank to cut its benchmark interest rate by 25 basis points down to 4.75%. And over to the land of the rising sun. According to data released on Friday, Japan's gross domestic product expanded by 0.3% in the third quarter of 2024, snapping 2 consecutive quarters of economic decline, which fits the technical definition of a recession. The data comes against the backdrop of the Bank of Japan raising interest rates in July from 0.1% to 0.25%, which is the highest level since 2008. Higher interest rates generally tend to slow down economic growth, and the Bank of Japan has stated that it will continue to raise interest rates as long as economic activity and prices continue to tick upwards. On Wall Street this past week, stocks tumbled on Friday as the post-election rally fizzled out and investors shifted their focus to Trump's cabinet nominations and the future direction of interest rates. The announcement by President-elect Donald Trump that he planned to nominate Robert F. Kennedy Jr., who is a vaccine skeptic, to lead the U.S. Department of Health and Human Services resulted in a sharp decline in pharmaceutical stocks that in turn weighed down on the Dow and the S&P 500. Traders also grappled with the recent comments from the Federal Reserve Chairman, Jerome Powell, who said that the central bank was not in a hurry to cut interest rates given that the U.S. economy remained strong. For the week, the S&P 500 posted a loss of 2.1% to close at 5,870, whilst the Nasdaq Composite slid by about 3.2% to end at 18,680, and the 30-stock Dow fell by 1.2% during the week to settle at 43,444. In the U.S. government bond market, the yield on the 10-year Treasury was marginally high on Friday, capping an eventful week of inflation data and comments from the Federal Reserve Chairman suggesting that the central bank may not be as aggressive in its rate-cutting campaign going forward. Following last week's 25 basis point rate cut, the Fed chairman noted that strong economic growth in the United States means that the central bank won't need to rush to cut interest rates. The yield on the benchmark 10-year Treasury bond closed the week at 4.43%, which was an increase of 12 basis points compared to last week's close of 4.31%. Meanwhile, the yield on the policy-sensitive 2-year Treasury note closed the week at 4.30%, which was an increase of 5 basis points compared to last week's closing yield of 4.25%. The Fed's current target rate sits between a range of 4.5 to 4.75%, and according to the CME Fed Watch tool, the futures trading implies about a 62% probability that the Fed will cut interest rates by 25 basis points at its December policy meeting. For your information, bond yields and prices have an inverse relationship, and 1 basis point is equal to 0.01%. In the commodity markets, the price of crude oil posted a weekly loss as traders anticipate an increase in supplies and a strong dollar, which further depressed the market. The International Energy Agency has forecast a surplus of more than 1 million barrels per day in 2025 on the back of robust production in the United States. In addition to that, the Organization of Petroleum Exporting Countries revised down its demand forecast for the fourth consecutive month as demand in China remains softer than expected. The price of the U.S. benchmark, that is West Texas Intermediate crude, lost nearly 5% this past week to settle at $67.02 per barrel, whilst the price of the global benchmark, Brent crude, declined by about 4% this past week and was last seen trading at $71.04 per barrel. In the precious metals market, The price of gold was on track for its largest weekly decline in more than 3 years as expectations for less aggressive rate cuts by the Federal Reserve lifted the dollar and dented the appeal for bullion. Earlier in the week, the Fed chairman indicated that the central bank was not in a hurry to cut interest rates, and therefore the prospect that interest rates will remain higher for longer has diminished the appeal for this non-yielding asset. Additionally, the dollar was set for its biggest weekly gain in more than a month, making gold more expensive for other currency holders. In summary, the price of spot gold fell more than 4% this past week and eventually settled at $2,562 per ounce. In the cryptocurrency market, Bitcoin continued its post-election rally with its price hitting an all-time high above $93,000 as traders poured through the inflation data for the month of October. Bitcoin, which has a limited supply of 21 million coins, is viewed as a hedge against inflation and fiat currencies in general, and has recently benefited from a post-election rally that lifted risk assets across the board. The price of the flagship cryptocurrency briefly rose to a fresh record high of $93,469 and for the week was higher by more than 3% to close at $92,612 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained flat versus the US dollar. And according to data obtained from the Central Bank of Kenya website, the official exchange rate for the dollar was quoted at 129.35. Meanwhile, the sterling pound was priced at 164.80 and the euro was valued at 137.44. And on the regional front, one Kenyan shilling was changing hands for 28.37 Ugandan shillings and 20.56 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.61. The dollar-shilling exchange rate has now been trading at the same rate of around 129.20 for the past 7 weeks. Under normal circumstances, even when a currency is stable, it normally fluctuates within a narrow range. However, what we are seeing now, where the dollar-shilling exchange rate is fixed at around 129.20, this is not normal price action and is a clear indication of market manipulation. And in my view, the only player who is capable of doing this is the Central Bank of Kenya. That said, the long-term outlook for the Kenyan shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined by $47 million to an amount of $9.27 billion, which is equivalent to 4.8 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances in the month of October 2024 totaled to $437 million, and this is compared to $355 million that was received in October 2023, which was an increase of about 23%. The cumulative inflows for the 12 months to October 2024 increased by 15% to $4.8 billion compared to $4.16 billion for a similar period in 2023. The inflow of remittances continues to support the country's current account as well as the domestic foreign exchange market. The United States remains the largest source of remittances into Kenya, accounting for about 54% of the total remittances that were received in October 2024. In the money markets, during the past week, the liquidity situation in the interbank market remained adequate and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined marginally to 11.87%, down from a rate of 12.09% that was recorded the previous week. And in terms of volume, the average value that was traded in the interbank market decreased to 27.5 billion shillings, down from 54.8 billion shillings that was recorded the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement, this stood at 44.9 billion shillings. For your information, the cash reserve is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 14th of November, and the central bank received bids totaling 95.5 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 398%. The central bank, however, ended up accepting only 43 billion shillings, and the results of the auction were as follows. The 91-day rate tumbled by 65 basis points to average out at 12.79%, whilst the 182-day rate dropped by 78 basis points to close out at 13.05%, and the 364-day rate declined by 54 basis points to eventually settle at 13.89%. In the primary bond market, the auction for the reopened 10-year fixed coupon Treasury bond was held on Wednesday, the 13th of November, and the central bank received bids totaling 55.5 billion shillings against an advertised amount of 20 billion shillings, representing a performance rate of about 278%. The central bank ended up accepting 30.5 billion shillings at a weighted average rate of 15.85% compared to the bond's coupon rate at 16% flat. In the Eurobond market, during the past week, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 7-year 2024 Eurobond increasing the most by about 10 basis points as it rose from 9.9% recorded the previous week to 10% flat. At the Nairobi Securities Exchange, during the week, the equities market recorded a mixed performance, with the NSE 25 gaining by 0.3%, whilst the NSE 20 and the NSE 10 both ticked up by just 0.1%, and the NASI declined by 0.5%. This takes the year-to-date performance to gains of 35.9% for the NSE 10, 33.8% for the NSE 25, 27.9% for the NSE 20, and 25.1% for the NASI. The market's performance was mainly driven by gains recorded by large-cap stocks such as Equity Group, Absa Bank, and Standard Chartered Bank, which increased by 3.9%, 2.7%, and 2.4% respectively. These gains were however weighed down by losses recorded by other large-cap stocks such as East African Breweries, Safaricom, and Bamburi Cement, which declined by 4%, 3.2%, and 0.4% respectively. Up next is our topical issue, and this week we are looking at the Treasury's Public Debt Management Report. 28 public institutions with a total loan portfolio of 946 billion shillings have defaulted on loans valued at 266 billion shillings, which means that the Kenyan taxpayer through the National Treasury will now have to step in and settle these outstanding obligations. In its annual Public Debt Management Report, the Treasury shows that by the end of June 2024, the total amount of outstanding loans that had been advanced to 54 public entities amounted to a total of 1.2 trillion shillings. However, about 80% of this outstanding debt, which amounts to about 946 billion shillings, was advanced to 28 public institutions with a poor financial history that have made no attempt to service their debts. Consequently, the Treasury has classified about 266 billion shillings as being in arrears as of June 2024. The largest defaulter was Kenya Railways, with a total debt of about 737 billion shillings, out of which 165 billion shillings was in arrears. The loan to Kenya Railways was procured from China Exim Bank and was used for the construction of the standard gauge railway. The second largest defaulter was our national carrier, Kenya Airways, with an outstanding loan of about 100 billion shillings, and which, according to the Treasury, no repayments have been received to date. The continued default by public institutions puts additional pressure on the National Treasury and raises the risk of a sovereign debt default. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color Podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color Podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, the world will long forget what you achieve in your lifetime, but give the world the best you've got anyway. Because at the end of it all, it's between you and your Creator. Think about it. Thank you, and God bless.